Today we're diving into the world of commercial and industrial property in Australia and unpacking a key concept every investor needs to know: cap rates. So, what are they? How do they work? And why should you care? Let's break it down. First up, what's a cap rate? Short for capitalisation rate. It's a simple metric used to measure the return on investment for a property. Think of it as a snapshot of how much income a property generates compared to its value. Here's the formula. Cap rate equals net operating income divided by the property value multiplied by 100 to get a percentage. Easy, right? In Australia, cap rates vary depending on the type of property, commercial or industrial, and where it's located. For commercial properties like office buildings or retail spaces in cities like Sydney or Melbourne, cap rates typically range from 4 to 7%. Why? High demand, premium locations, and stable tenants push property values up, which often lowers the cap rate. On the flip side, industrial properties like warehouses or logistics hubs often see cap rates between 5 and 8%. These properties might be in outer suburbs or regional areas where land is cheaper, but the rise of e-commerce has made them hot commodities. Now, cap rates aren't set in stone. They fluctuate with market conditions. When interest rates rise, like we've seen lately with the Reserve Bank of Australia tightening monetary policy, cap rates often creep up too, as investors demand higher returns. But in a booming market with low rates, cap rates compress as property prices soar. It's all about supply, demand, and the cost of money. Let's put it into action. Say you've got a commercial property in Brisbane worth $2 million, pulling in $120,000 a year in net income. After expenses like maintenance and taxes, divide that income by the value, multiply by 100, and boom, a 6% cap rate. That's your annual return if you paid cash. For an industrial shed in Perth with a $1 million price tag and $70,000 in net income, you're looking at a 7% cap rate. Higher risk, higher reward. Location matters too. Prime spots in Sydney's CBD might fetch cap rates as low as 4%, reflecting high competition and lower risk. Head to regional areas like Townsville or Geelong, and you might see 7% or more as investors weigh up lower tenant demand against cheaper entry prices. So, what's the takeaway? A lower cap rate often means a safer bet. Think blue chip tenants and premium locations. A higher cap rate, potentially more income, but it could signal higher risk like vacancy or maintenance costs. It's your job as an investor to decide what fits your strategy. That's cap rates in a nutshell. So if you want to know more, speak to an agent that specialises in commercial and industrial real estate. And once you've had a look at the numbers, if you're after a commercial property loan, give me a call. Let's see if I can help. Look forward to hearing from you. Thank you.
Shorty could do anything for money. Do like a diva, do like a ripache. I get what you want to tell me love. Do like a diva, do like a ripache. I get what you want to do by the leg. And there I guess, mommy, there I guess, mommy. You come to what to my chest. Get the mula to my back. And there I guess, mommy, there I guess, mommy. Come to what to my chest. Get the mula to my back. Everything cause trouble. fever gan. But this get the stress me for color.